If you're putting your money into mid-cap mutual funds, you've almost certainly crossed paths with these three absolute heavyweights: Invesco India Mid Cap, WhiteOak Capital Mid Cap, and HDFC Mid Cap. Today, we're going to do a deep, data-driven breakdown of these three massive Indian mid-cap funds to see what's really going on under the hood.
But, how do you actually figure out which one belongs in your specific portfolio? We're looking at the single biggest mid-cap fund in India, one that's barely 3 years old, and one that boasts some truly incredible return consistency. But here's the kicker. Holding all three of these at the same time might actually be the ultimate diversification trap. Let's find out which one truly fits you.
Okay, let's dive into this. 1. Meet the contenders. 2. Trailing versus rolling returns. 3. Fund investment styles. 4. Key holdings. 5. The portfolio overlap trap. And 6. Final verdict.
Section 1. Meet the mid-cap contenders.
Right out of the gate, we've got a really clear contrast. Invesco, managed by Aditya Khemani, sits comfortably right in the middle ground. It launched back in 2007 with a highly competitive 0.49% expense ratio. Then you've got WhiteOak, literally the new kid on the block, launching in 2022. Now, because it's under 3 years old, we just don't have a full market cycle to judge it on quite yet. And then, well, there's HDFC.
Just look at that number. Over 1 lakh crore rupees in assets under management. HDFC is an absolute giant. It's the single largest mid-cap fund in the country, and it added over 3,500 crore in just the last month alone. That sheer scale is absolutely crucial context as we look at how it performs. Section 2. Trailing versus rolling returns.
When we look at the 3-year trailing returns, Invesco clearly takes the lead at 25.5%. HDFC, despite its massive size, is kind of lagging behind at 19.4%. Honestly, when a fund gets as huge as HDFC, it can become a bit like steering a massive cargo ship. It's just too big to move nimbly in the mid-cap space anymore. WhiteOak looks solid here at 23.5%, but remember, they lack a 5-year track record, so we can't extrapolate too far into the future.
Now, what's really interesting about this is when we switch our lens over to 3-year rolling returns. Because rolling returns measure performance across overlapping blocks of time, they smooth out the lucky or unlucky timing of a specific start date. And wow, look at what happens. HDFC actually edges ahead of Invesco on pure consistency, hitting 28.8% compared to Invesco's 27.1%. It tells a much more honest story about stability than trailing returns alone.
Section 3. Decoding fund investment styles.
To truly understand these returns, we have to look under the hood. Let's contrast HDFC and Invesco. Think of HDFC as a very stable, steady ship. Fund manager Chirag Setalvad is known for a patient style, always looking for companies with a durable moat, meaning they have a strong competitive advantage that protects their profits long-term. Because it's so large, it's naturally more diversified across roughly 78 stocks. Invesco, on the other hand, is more like an agile speedboat. It has a benchmark-aware, growth-oriented bias that relies heavily on active stock picking. Then we have WhiteOak Capital, managed by Ramesh Mantri and his team. They bring a completely different flavor to the mix. It's a quant-informed, systematic, factor-diversified process. Basically, they're using mathematical models to pick stocks based on specific traits, heavily leaning into real estate, financials, and healthcare right now.
Section 4. Key holdings and consensus bets. Do you notice a pattern here? Across all three of these wildly different funds, Federal Bank and Max Financial Services show up as top picks for everyone. That tells us something very important about the current market. Right now, private and small finance banks, along with the Max Insurance Group, are massive consensus bets across Indian mid-cap fund managers, completely regardless of their specific investment style.
Section 5. The portfolio overlap trap.
So the crucial point is this. If you hold multiple mid-cap funds thinking you're safely spreading out your risk, you aren't automatically getting true diversification. Let's look at the exact overlap percentages to see what's actually happening inside your portfolio. Look at this incredibly aggressive number, 26.44%. This is the highest overlap pair in our entire analysis, and it's the specific overlap between WhiteOak and HDFC. And this brilliantly illustrates what that actually means in practice. Holding both WhiteOak and HDFC means over a quarter of your money is just buying the exact same stocks twice. That severely limits the diversification you probably thought you were paying for by holding 2 separate mutual funds.
On the flip side, we have 13.69%. This is the lowest overlap number we found, and it really presents the optimal solution if you're looking for true, efficient diversification across the mid-cap space.
Notice the highly complementary nature of Invesco and WhiteOak. With nearly 86% of the portfolios being completely unique to each other, this proves to be the most efficient two-fund combination out of the three. You basically get Invesco's agile growth and WhiteOak's quant-driven approach, all without stepping on each other's toes.
Section 6. Final verdict on takeaways.
Okay, here's our 5-point verdict to sum the whole shebang up. Number 1, the best returns contest is a super close call. Invesco wins on trailing returns, while HDFC takes the crown for rolling consistency. Number 2, the most battle-tested fund is undeniably HDFC, with its massive AUM and stable 19-year track record. Number 3, the most nimble approach goes to WhiteOak, though you should probably wait for a longer track record before making massive bets. Number 4, our best combo for diversification is Invesco paired with WhiteOak. And finally, number 5, the least efficient combo is WhiteOak plus HDFC due to that surprisingly high portfolio overlap.
Now, before we wrap up, just our standard reminder, this explainer is a breakdown of financial data, definitely not direct investment advice. Past performance doesn't guarantee future returns, and all of our data is as of July 2026. If you find these data-backed explainers helpful and want to keep making informed decisions, make sure to subscribe so you never miss an analysis.
I'll leave you with this provocative thought. Which mid-cap fund are you currently holding in your portfolio? And hey, if you hold more than one, did this overlap data make you think about trimming a bit to avoid that diversification trap? Drop a comment below with your current holdings, and I'll gladly help you think through it in our next explainer.